The Iran war could keep your mortgage expensive, not because bombs magically change interest rates overnight, but because when war hits oil and gas, inflation can come back just enough to stop central banks from cutting rates. And by the end of this video, you'll understand exactly how a conflict thousands of miles away could keep fuel, bills, loans, and the price of money higher for longer. Most people hear oil prices are rising and think, alright, petrol gets more expensive. That's true. But that is the surface level story. The deeper story is that energy is built into almost everything: transport, food, heating, electricity. So when energy jumps, it doesn't stay in one corner of the economy. It starts pushing on inflation, and that is where this gets dangerous. On March 19th, after Iranian attacks on Gulf energy facilities, Brent crude briefly hit $119.13 a barrel, and WTI touched $100.02. At the same time, European gas prices jumped to their highest level in 3 years. That is not a small move. That is markets screaming that this conflict may not stay contained to the battlefield. Because here's the real issue: central banks were already struggling to fully finish the inflation fight. The day before, on March 18th, the Federal Reserve kept rates unchanged, saying uncertainty around the economic outlook remains elevated. In the Fed's updated projections, PCE inflation for 2026 was put at 2.7%, with 2027 at 2.2%. So inflation was already proving sticky. Now add an energy shock on top. That is exactly the kind of thing that can make central bankers sit on their hands for longer. And that is why this story matters so much. Because this is not really about oil, it's about rate cuts. If oil and gas stay elevated, inflation can stay elevated. And if inflation stays elevated, central banks become much less willing to cut interest rates. Why? Because rate cuts make borrowing cheaper. Cheaper borrowing can boost spending. And if prices are already being pushed up by energy, policymakers do not want to pour more demand into the system too early. That is how inflation gets a second wind. So suddenly, a war story becomes something more. Even if you barely buy fuel, you can still feel the effects. Quick pause. If you're tired of AI slop and recycled garbage flooding the economics and finance genre of YouTube, subscribe. I make real videos for real people who actually want to understand what's going on. Anyway, back to the video. Now look at what happened in Britain. On March 19th, the Bank of England held rates at 3.75% in a unanimous 9-0 vote, and warned inflation could rise to 3.5% over the next 2 quarters if the energy shock persists. That tells you everything. When oil and gas jump, central banks do not suddenly get relaxed. They get nervous, and when central banks get nervous, rate relief gets delayed. So let me ask you, if energy prices surge and inflation starts climbing again, why would a central bank rush to make money cheaper? It wouldn't. That is the part most people miss. Now, the reason markets care so much comes down to one narrow stretch of water, the Strait of Hormuz. According to the International Energy Agency, about 20 million barrels per day pass through it. That is roughly a quarter of global seaborne oil trade. Around 19% of global LNG trade also moves through the same choke point. That is enormous. And the IEA says only around 3.5 to 5.5 million barrels per day of pipeline capacity can bypass it. So if traders think Hormuz could be disrupted, they do not wait for the disruption to happen. They reprice everything now. That is why these moves happen so fast. And there is another layer here most coverage misses. This is not just an oil shock, it is also a gas shock. Reuters reported damage linked to Qatar's Ras Laffan LNG complex, which matters because gas feeds directly into heating bills, electricity prices, and industrial costs, especially in Europe. So now you have the exact mix central banks hate: higher energy costs, higher inflation risk, weaker growth, and more uncertainty. That is the kind of setup that creates a stagflation scare, and when policymakers smell stagflation, they do not turn soft, they turn cautious. Now, to be clear, this does not mean rates are guaranteed to stay high forever, and it does not mean one oil spike instantly rewrites the whole economic outlook. But it does mean this: the bar for rate cuts just got higher. Because even if oil falls back later, the shock has reminded central banks how fragile the inflation picture still is. And there is real evidence behind this. In a 2024 Federal Reserve Fed's note, Economists Ignacio Preshno and Andrea Prestipino estimated that a 10% increase in the real oil price lifts US headline inflation by about 0.15 percentage points over the first 4 quarters in their model. That may sound small, it isn't, because central banks are often deciding policy on the margin. Sometimes a few tenths of inflation is the difference between cutting and waiting. And the European Central Bank's 2025 strategy review made the same broader point after the last big energy shock. Strong tightening was needed to stop higher energy costs from feeding into wages and becoming more persistent inflation. This is the chain. War hits oil, oil hits inflation, inflation hits rate cuts, and rate cuts get pushed back. That is why this matters. Not just because petrol gets pricier, but because money stays expensive. So will central banks still cut this year? Let me know in the comments. Subscribe for more. See you in the next one.